Ready to crack the code of your financial choices? Join us on an eye-opening journey where we explore the powerful intersection of finance and psychology. In this video, we'll peel back the layers of emotions, biases, and hidden influences that shape our every investment decision. By understanding the why behind your financial decisions, you gain the power to make lasting changes and build a brighter financial future. Don't miss out. Buckle up and get ready to unravel the mysteries of your money mind. 1. Riding the emotional waves in investing. The emotional roller coaster in investing reflects the tumultuous journey investors undergo in financial markets. During bullish periods, confidence soars, leading to overconfidence and impulsive decisions driven by the fear of missing out, FOMO. However, when markets take a downturn, panic sets in, prompting hasty selling to cut losses. This roller coaster of emotions can significantly impact investment performance, as emotional reactions often lead to buying at market peaks and selling at market lows. 2. Confirmation. Bias in investing. Trust the gut or seek the truth. Now let's talk about confirmation bias, a fancy term for a common quirk in decision-making. Picture this: you believe a tech company is the next big thing. What happens? You start hunting for news and opinions that support your view, ignoring anything that says otherwise. It's like having blinders on. This bias can sway investors to overlook potential challenges or overvaluation signals. So, while optimism is great, it's essential to stay open to different perspectives for a well-rounded investment strategy. 3. Overconfidence in investing. The knowledge pitfall. So, you think you've got it all figured out in the investing game? Well, that's what overconfidence is all about. Investors falling into this cognitive trap tend to overestimate their skills and understanding of the markets. It's like thinking you're a market guru when, in reality, you might be missing the mark. This overconfidence often leads to excessive trading, higher costs, and, you guessed it, less than ideal investment outcomes. Some might believe they can time the market or always pick winning stocks, but the truth is, even the pros struggle to consistently beat the market. Plus, overconfidence can blind investors to crucial information and downplay risks. 4. Loss aversion, the emotional investing tug of war. Now, let's dive into loss aversion, a psychological bias that's pretty common in the investing realm. Here's the scoop. People hate losses more than they enjoy gains. It's just how our brains are wired. In investing, this aversion to losses can lead folks to make less than optimal choices. Picture this. When facing the idea of selling an investment at a loss, many might hesitate, hoping the market will bounce back. This delay tactic can mean holding on to underperforming assets for too long, resulting in more losses. Loss aversion can also trap investors in the sunk cost fallacy, where they keep pouring money into a losing investment just because they've already invested a lot and can't bear to accept the loss. Tricky, right? 5. Herd mentality. Following the investment crowd. Let's talk about herd mentality, also known as the bandwagon effect. Picture this: a bunch of investors all rushing to buy or sell a particular asset just because everyone else is doing it. Sound familiar? Well, it happens more often than you think. When investors see a mass movement, they might join in, fearing they'll miss out on potential gains or avoid losses. The catch? This can lead to market bubbles and crashes, with asset prices losing touch with their real value. Herd mentality also tends to narrow down portfolio diversity, as everyone rushes for the same popular assets, increasing overall risk. The antidote? Thorough research, a solid investment strategy, and the courage to go against the crowd when it makes sense, based on your analysis. 6. Anchoring, the investing mind trap. Now, let's unravel the concept of anchoring, a cognitive bias that can seriously mess with investment decisions. Imagine this: relying too heavily on the first piece of info you get, even if it's not really relevant. In investing, anchoring can play out in different ways. For instance, an investor might set their expectations for a stock's future performance based on its historical high price, even if market conditions or the company's fundamentals have drastically changed. This can lead to unrealistic expectations and not so great decision-making. Another scenario: investors getting fixated on the purchase price of an asset, refusing to sell for less than that price, even if the current market value is way lower. Result: holding on to underperforming investments for way too long, hoping they'll magically bounce back to that anchored price. 7. Regret, Aversion, steering clear of investment. Sorrows. Ever heard of regret aversion? It's a behavioral bias where individuals make choices solely to avoid the gnawing feelings of regret or remorse. Now, in investing, this bias can pack a punch. Investors driven by regret aversion might avoid decisions with perceived risks, leaning towards safer but lower yield investments to dodge the regret of potential losses. Even if a more diversified or dynamic strategy could bring in more financial gains over the long haul, they stick to the safe side. Regret aversion can also lead to holding on to losing investments for way too long, hoping they'll bounce back to that initial purchase price. 8. Diversification. Benefits. The power of spread. Let's talk diversification, a game changer in the investment world. Picture this: spreading your investments across various asset classes, industries, and geographic regions. The big win? Risk reduction. When your portfolio is diversified, the performance of one single investment has less impact on your overall financial picture. If one investment isn't doing so hot, the positive performance of others can balance things out, protecting your portfolio from wild market swings. But that's not all. Diversification also opens the door to enhancing long-term returns. By holding a mix of assets with different risk and return profiles, you can grab growth opportunities while maintaining a stable foundation. 9. Goal-based investing, crafting your financial journey. Let's talk goal-based investing, an approach that's all about nailing specific financial objectives instead of chasing generic market returns. Here's the scoop. Investors identify their unique financial goals, whether it's saving for retirement, snagging that dream home, funding junior's education, or jetting off on a vacation of a lifetime. Once the goals are laid out, investors tailor their portfolios based on each objective. Every goal gets a designated time horizon and risk tolerance, shaping the perfect asset allocation and investment strategy. The beauty of goal-based investing? It keeps individuals laser-focused on their real-life financial goals, fostering discipline in their investment decisions. 10. Behavioral finance, decoding financial decisions. Behavioral finance, a fusion of psychology and economics that unveils how individuals make financial decisions. Unlike traditional finance theories assuming everyone acts rationally, behavioral finance recognizes the impact of cognitive biases, emotions, and other psychological factors on decision-making. Picture this: irrational behaviors like overreacting to market news, being swayed by social trends, or succumbing to the whims of fear and greed. It's all part of the intricate dance that shapes investment choices and market outcomes. Thanks for embarking on this insightful journey into the intricate relationship between the human mind and investment choices. Don't miss out on more captivating episodes. So remember to hit that like button, subscribe for more, and stay tuned for a wealth of intriguing insights.